Namaskar. This is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The NPA crisis continues to plague India's banking and finance industry, and it has been a heavy drag on its economic growth. While its roots lie in the 2008 economic meltdown and the ensuing frenzy of reckless, corrupt and crony bank loans in India between 2008 to 2013, it is the COVID crisis lockdown which is now building up yet another massive round of NPAs on the bank balance sheets. All attempts and initiatives to resolve the NPA crisis in the past decade have failed to resolve it and improve the condition of the Indian banks. These initiatives have included restructuring schemes under the CDR, SDR and S4A packages, the ARCs, the PCA scheme of the Reserve Bank to nurse back banks, the Insolvency and Bankruptcy Code, bank mergers, recapitalization of banks, the moratorium, and now the setup of a bad bank, which may be the ultimate remedy perhaps at the disposal of the government. If we go back to the economic meltdown of 2008, which had caused a huge global banking crisis, particularly in the Western nations, we note that those nations have handled their NPAs in a much better and effective way, such that, as per the latest available figures from the World Bank, the bank NPAs in USA today are at a mere 0.9% of the total advances. In the UK, they are at 1.1% of the total loans. In Sweden and Switzerland, the figure is a paltry 0.6%. In Norway, it is at 0.8%. In Germany, it is at 1.1%. And in France, it is at 2.5%. India stands at about 9% according to us. Even comparable economies have fared much better than India, with the NPAs being at 3.1% in Brazil, 2.4% in Indonesia, 2.1% in the case of Mexico, 3.9% in the case of South Africa, and 1.5% in Malaysia, with Russia being an exception at 9.3%, almost at par with India. While the figure of bad debts of banks is reported to be at 1.86% in the case of China, experts say that the actual figure there could be 4 to 5 times of this official figure, which means that Chinese banks too are in a serious mess but are hiding their reality. If India wishes to revive its economy and record rapid growth, then it needs to resolve the NPA crisis and strengthen its banks. Banking support is a must to attain durable growth, which the NPA-stricken Indian banks have been reluctant and unable to provide. The Modi government has failed to resolve the NPA crisis primarily because the efforts to do so since 2014 when it came to power have been patchy and devoid of an overall and defined strategy according to us, and it has thus lacked any efficacy. To us, it appears that the government and the Reserve Bank have perhaps failed to truly understand and appreciate the very cause of the NPA crisis, and they have thus failed to formulate a suitable strategy to resolve this massive crisis that we face on the Indian economy as far as the banking industry is concerned. A recent article co-authored by Dr. Rangarajan, the eminent economist and former governor of the Reserve Bank, speaks about the causes of NPAs and how do we prevent their pile-up in India. The article points out with concern that as per the latest financial stability report of the Reserve Bank, the NPAs, which had fallen to 7.5% of the total bank advances as at 31st March 2021, mainly due to the huge write-off of bad loans by banks. These NPAs are expected to rise to 11.2% by March 2022, which surprisingly is less than the Reserve Bank's own earlier estimate of up to 14.8%, despite there being no perceptible improvement in India's banking system and the economy. Dr. Rangarajan notes that though large advances have contributed to 77.9% of these bad loans, however, with the severe stress in the MSME sector, its contribution in the NPA pile, which is the contribution of the MSME sector, is likely to go up sharply. The authors then discuss the causes for the build-up of the giant mountain of NPAs in India and what are the causes according to them. The first one, India has a weak and dilatory ecosystem for the recovery and settlement of bank loans, despite the introduction of the Insolvency and Bankruptcy Code, which explains why cases are settled in the NCLT at even 95% plus haircuts to the banks. And because of that, the total losses and write-offs of banks have been to the tune of 4 lakh crores in the past 4 to 5 years, they point out. The second cause, India has witnessed bouts of excessive credit as between 2008 to 2013, and then bouts of credit declines as we see now, which the authors say have harmed the bankers, have harmed the lenders, and the overall system, which needs to be avoided. They say that it is due to this that even after considering genuine business failures, it is the excessive lending, it is the lax credit standards of banks, it is their poor monitoring, it is diversion and siphoning of funds by the borrowers, it is malfeasance and frauds that have caused the high level of NPAs that we face today. They then say that it is evident from several audit and investigation reports that banks need to improve their credit appraisal techniques and processes and strengthen the banking system. While sanctions and approvals have often been weak and incompetent, it is the weak and patchy monitoring system thereafter which has led willful defaults of lakhs of crores take place, according to these eminent authors. They say that information flow from the borrower is often scanty, delayed, and unreliable, and that despite having 20 monitoring tools at their disposal, the bankers very often fail to connect the dots and they are not able to pre-warn or sense out a NPA in the making. They then say that despite the SME classification norms, early warning signals which can be easily picked up by the bankers are yet not picked up. To us, that shows clear incompetence on the part of the banks or negligence. The next cause they point out is that banks need a better supervision that distinguishes between what they say secular and cyclical declines in industries. They point out the case of the steel sector when in 2012 the steel prices fell down to $300 a ton and caused huge sickness. But now they have come up to $1,000 a ton and the industry is doing very well. At that time, banks wrote off loans of almost 1 lakh crores, which they think was avoidable. They say that banks need much better and responsible governance, with a key role being played by their independent directors, whose performance, according to them, must be appraised by the authorities from time to time. The next factor they say is that while bank boards cannot be responsible for each and every credit decision failure unless there is malfeasance, however, the massive buildup of NPAs is a reflection of major fault lines in business strategy, in risk, in management strategy, in capital management, and failure of tactical and strategic issues at the level of bank boards. They think that's a serious reason. They then say that since the government is the owner of the public sector banks, the Department of Financial Supervision is an interested party and should thus issue only the broad policy guidelines and should refrain from issuing any borrower-specific advisories. Unless this principle is adhered to in letter and spirit, the banks, according to them, cannot be held responsible for their poor performance. And finally, they say that banks are not good at infrastructure funding and for which development financial institutions are needed, and they are happy to note that they are being set up. In order to resolve the crisis, the way ahead, according to Dr. Rangarajan and his co-author, is on multiple fronts. They say that the banks, the Reserve Bank and the government are all responsible to minimize the probability of bank loan default. They then say that appraisal and monitoring techniques need to be revisited, reset, and skills need to be upgraded. The next point they say is that the Reserve Bank must identify and prevent excess lending and credit concentration. They then suggest that banks must distinguish between cyclical and secular declines in industry and choose forbearance accordingly. The next cure to be implemented, they say, is that boards need to identify and mitigate strategic risk and mitigate exuberance. They say that the government as the owner needs to redefine its engagement with public sector banks and give no customer-specific advisory. And finally, they advise that the government and the Reserve Bank need to strengthen the entire legal ecosystem, including the institution of the resolution professionals who have played a very dubious role according to them, and we of course would agree with them. The fact of the matter is that the NPA crisis is a serious issue. It has been dragging down, pulling down India's GDP growth rate. Until this crisis is not resolved, the economy will not pick up its potential steam. We think that the diagnosis and the prescription that comes from Dr. Rangarajan is very apt, and we do hope that the government is listening. This is Akhilesh Bhargava signing off till we meet again. Namaskar.